Now, with the Delta variant raging and a slowdown conceivably on the horizon, we could be looking at demand problems. So I don't know if oil can even hold above 60 these days. Most American producers are still plenty profitable above 60, but below that level, it does start to get more dicey. What do you do if you want to buy an oil here? Well, first and foremost, you need plenty of yield support. Devon and Pioneer Natural Resources both have what are known as variable dividends, meaning their payouts could shrink as oil comes down or maybe grow as oil stays the same or goes up. If you want something less risky, how about Chevron, fixed dividend? Here's a stock that everyone seemed to just be gaga about a few weeks ago, and now can't get any love. The stock's fallen from $113 to $94, but at these levels, it sports 5.7% yield. I like Chevron very much here. Now, we know there are existential threats to this group because they are less carbon-based. While many of these companies have made major efforts to reduce their carbon emissions, including ExxonMobil, where some newly board members are committed to making the company, let's just say, a lot more environmentally friendly. The fact is, well, these are all oil companies. If governments around the world wanted to crack down on climate change, it doesn't matter how much they do to try to offset their emissions. However, at the moment, you don't need to worry about regulators crushing the fossil fuel industry. You just need to remember that when oil was in the 60s on the way up, the bulls got way too excited, pushed it to the 70s, and then got overwhelmed by a wave of new supply. Oh, and be careful, because oil may not be done rolling over yet.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.